Bad portfolio structure loses more money than bad trades, and I can prove it. In the last bear market, portfolios with proper structure recovered within about 8 months. Random coin collections though, most still down 70 to 80% today. The difference is a sound structure of smart diversification. Every week you read about people with 100,000 portfolio lose 80% in a crash. Not because they picked the wrong coins, but because they had zero structure or were simply gambling, maybe out of lack of knowledge, lack of care, lack of experience, or all of the above. So in this video, I'm breaking down the exact 3-tier framework that protects your portfolio when the market crashes. Let's dive in. Here's what happens when you build a portfolio without structure. Most beginners do this. They hear about a hyped coin on Twitter, throw in $500, next week another coin and another one, and after 3 months, they've got 15 different coins with no plan whatsoever. Just jumping the hype train, eventually being the exit money for early adopters and fraudulent calls. The problem is, in a crash, everything falls differently. A blue chip like Bitcoin is about falling 50%. Mid-cap altcoins can fall up to 70%. And low-cap shitcoins like random memes, the ones with the light-hearted approach and the all for the community thing, can fall down 95 to 99%. If your entire portfolio is random low caps, you are completely wiped out in a crash without the possibility of a rebound. It's like an investor who only invests in startups with zero blue chip stocks. Works great in a bull market, but the first crash kills you. You need structure. You need layers of protection. And that's exactly what most people are missing. So here are the 3 main mistakes. The shiny object syndrome. You see a coin bumping 50% in a week, FOMO kicks in, you buy, repeat this 15 to 20 times. Now you have 20 random coins with zero strategy and the high likability that they fall down to zero again. Mistake 2. Equal weight delusion is already announced. I'll put 500 in each coin to diversify. Well, sounds smart, but here's the problem. You are giving the same weight to Bitcoin and the 2 million market cap meme coin and all other 20 million whatever coins out there. You start as a billionaire to become a millionaire. When the crash comes, your so-called diversification gets destroyed. Mistake 3. No exit plan. You buy coins but never decide when to take profit. Market pumps 3x, 5x, 10x, you hold. Market crashes 80%, you panic sell at the bottom. This is backwards, and it's why most portfolios never recover. So if random buying doesn't work and equal weight distribution is a trap, what does actually work? That's where the 3-tier framework comes in. The solution is simple. Split your portfolio into 3 tiers based on risk. Tier 1, foundation layer, the blue chips, survive every crash. Mostly, if they are not Terra Luna, it's fine. Think about Bitcoin, Ethereum, and maybe 1 or 2 hours out of the top 10 to top 15 current market cap. This is your safety net when the markets crash. Tier 2, the growth layer, established altcoins. High potential, moderate risk, mid-cap projects with proven track records, established protocols, real users, and actual revenue. Tier 3, the moonshot layer, high-risk plays. This is where money is made, or mostly lost, because it's small cap, high-risk plays. This is where you take calculated risks. But notice, it's only 10 to 20% and not your entire portfolio's money. When the market crashes, Tier 1 protects you. When the market pumps, Tier 3 gives you the gains. And this way you are covered both ways. The art is in the percentage allocation, depending on your risk profile. A conservative investor might go to 70% tier 1, while an aggressive trader might do 40% in tier 1. Think of it like building a pyramid. You need a solid foundation at the bottom. Without it, everything collapses. With it, you can take calculated risks on top. And that's exactly what we are going to break down now. The exact percentages, real portfolio examples, and how to adjust on your risk tolerance. Tier 1 breakdown. Let's start with Tier 1, your foundation. This is 40 to 60% of your total portfolio. What goes into Tier 1? Okay, we had Bitcoin, we had Ethereum, but maybe one more, like Ripple, Solana, Binance Coin, Cardano, and that's it. It's that simple. These assets have survived multiple bear markets. They have the deepest liquidity, and you can always sell them. When altcoins crash 90%, these might only drop 60 to 70. Still sounds horrible though, but you get the point. The difference is what keeps you in the game. So the allocation with tier 1 is like conservative approach would be around 70% Bitcoin, 30% Ethereum. A moderate approach would be like 50% Bitcoin, 40% ETH, and 10% of one of the alts that I mentioned. The point is, you are not trying to get rich here. You are trying to not get wrecked. Tier 2 is your growth engine. 30 to 40% of your portfolio. Top 20 to top 150 coins with real use cases established enough to survive crashes, but young enough for 5 to 10x potential. Stick with a maximum of 5 to 8 different coins in this layer. More than that, you can't track them properly. So, what goes down in Tier 2? Mid-cap projects with proven fundamentals. Look for real users, actual revenue, established teams. Examples could include layer 1 and 2 blockchains like Sui, Avalanche, Polygon, DeFi protocols with real TVL like Aave or Uniswap, infrastructure tokens like Chainlink or the Graph, and well, aim for 5 to 8 positions maximum and not 20 or more. A selection criteria could be a market cap around, let's say, start with 200 million to 10 billion range. At least 1 to 2 years of operating history. Active development. Check GitHub for that cause. Real community and not just hype. Tier 2 is where you balance safety and upside. This can 3 to 10x in a bull market, but they won't completely disappear in a bear market either. Tier 3 is your moonshot allocation, and I bet you already waited for this all the time. But let me point this out, it's only 10 to 20% of your overall portfolio's value that you should put into this tier. New projects, high risk, high reward plays. This is where you can make 50 to 100x, but it's also possible to lose 100%. Rule of thumb. Never more than 5% of your total portfolio money in one single moonshot. So, what goes in tier 3? Small caps, high risk projects like new layer 2s, DeFi protocols, gaming tokens, real world asset tokenization coins, maybe meme coins if you want to, and they are outside far of the top, let's say 300-400 in overall market cap. So market cap value about 500 million or lower. They are usually early stage protocols, new narratives, emerging sectors. This is where you can take big swings. But here's the rule, only invest what you can afford to lose completely. The psychology is usually that most people do it backwards. They put 80% in moonshots and 20% in Bitcoin. And that's it. And then they wonder why they are broke after every crash. Don't be that person. Within tier 3, spread across 3 to 5 positions. If one goes to zero, it's only 2 to 4% of your total portfolio. See this as your lottery ticket money. Money you are prepared to lose completely. If losing this money would hurt you, You have allocated already too much. Let me show you 3 real portfolio examples: conservative, moderate, and aggressive, based on the tokens we already mentioned. A conservative portfolio you might not be interested in, but I mentioned it anyway. We start with $10,000 of a total portfolio value. Tier 1, 60%, 4,000 in Bitcoin, 2,000 Ethereum. Tier 2, 30%, 1,000 in Avalanche, 1,000 in Chainlink, 1,000 in Aave. Tier 3, 10%, 500 in 2 small caps, like go to Alex Becker and call him for Altura or Defina Finance. Better not for the latter, but though. So anyway, this is for people who want to sleep at night. 70% improve assets means even in a brutal crash, you are not losing everything. This portfolio is perfect if crypto is part of your retirement strategy or if you can't handle high volatility. Next one, the moderate portfolio, again with $10,000 as an example. You can scale it up and down, so just for the example, we stick with 10K. Again, moderate portfolio tier 1, 3,000 in Bitcoin, 2,000 in ETH. Tier 2, 35% across 5 to 6 midcaps. Let's use coins here like Render, like Quant, like Psy, like Starknet, VeChain probably, like Celestia, Injective, and so on. Tier 3, 15%, 1,500 spread across 3 to 4 moonshots. This is the sweet spot for most people, balanced between safety and upside. You've got enough blue chips to survive, but enough altcoins to really profit in a bull run. And this is what I personally run with. The final one, what most people unfortunately do. Aggressive portfolio, again with a 10K example. Tier 1, 40%, 2.5K for Bitcoin, 1.5K for ETH. Tier 2, 40% again, 4,000 across 6 to 8 growth plays. Again, what you already mentioned, and maybe add some more like out of the top 200 to it, like Sonic, Radio, or Ether. Tier 3, 20%, 2,000 across 4 to 5 high-risk bets. Here are a few examples. Again, higher upside, but you need a strong stomach. Important, aggressive does not mean 100% shitcoins. You still need that 40% blue chip safety net. I've seen too many so-called aggressive portfolios with 0 Bitcoin or Ethereum, and they get absolutely destroyed in any single smallest, even in the smallest crashes actually, so to be quite frank. So don't be that person. One of those things that people also neglect is to track and monitor their portfolio. You can't manage what you don't measure. Here is how to track your portfolio without obsessing over it. Use threshold-based alerts, not calendar-based. Don't rebalance every month or quarter automatically. Instead, set 10 to 50% drift alerts. Only rebalance when your allocation moves meaningfully away from targets. Like tool suggestions from my end would be like most portfolio trackers, CoinGecko, Delta, CoinMarketCap, and even a simple spreadsheet on Google is already more than enough. And let you set percentage alerts. Track these 4 metrics weekly. Current allocation versus target allocation. Are you drifting in your percentages? Unrealized gains, losses per tier. Which buckets are performing and which are not? Days since last rebalance. Prevents overtrading. And total portfolio value trend. Are you growing overall? Let's recap what we've covered in this video. The 3-tier allocation framework, the foundation, the growth, and the moonshots. Real portfolio examples at conservative, moderate, and aggressive levels. And here's what to do next. Step 1. Audit your current portfolio. What percentage is in each tier right now? Step 2. Decide your risk tolerance. Conservative, moderate, aggressive, hyper, super aggressive meme coin. Step 3. Rebalance toward your target allocation over the next 30 days. No need to rush it. So, if you found this helpful, hit subscribe. I break down crypto strategies like this every Monday. Building the portfolio is only half the battle. So next week I will show you the rebalancing strategy that locks in profits. And drop a comment. What's your current portfolio allocation? Are you heavy in moonshots or do you play it safe? Having a boring, safe portfolio is not sexy, it's not exciting, but it works. And in crypto, what works is what keeps you in the game long enough to actually make the life changing money. So, until then, invest smart, not hard. See you in the next one.